for your first judging interview?
Yeah,
In the middle of something.
actually come around and I'll show you what we're about ready to do here. We're doing LinkedIn Live show.
Oh, wow.
So, let's get my volume. Hey, Greg, can you hear me?
Get out of your shot.
Oh. Oh, you know what? I gotta shut this off.
So this is you. I just want to take a picture.
Can you hear me now, Mike?
Yes, I can hear you. I am struggling a little here. Let's see, sound. That's where I need to go. Settings, audio.
All right. Hello. Can you hear me, Greg?
Yeah, I can hear you now.
Oh,
Yep.
there we go. Okay. Now you're in my ear. Let me just get this volume cranked up. All right, we should be good to go. It's got about one more minute for noon. So hey, I'm at the Builders Show, International Home Builders Show.
Where's that show at, Mike?
It is in Orlando.
Nice. It's not a bad place to be.
Wow, a little chilly today. Hang on a second. A little bit chilly, but it's a very busy show today. I'm pretty impressed.
That's awesome. Good. A lot of guys optimistic, or what? What's the consensus so far?
Yeah, so far they're having some challenges getting their hands on lumber. There's concern about building materials.
Yeah.
Gone are the days when you've got 6 different yards trying to sell you job packages.
No, you're lucky to find one that doesn't overcommit and can't honor their agreements when it all comes due. So.
Yeah. All right. Well, let's get her going. Hello, everyone. It is Lumber Futures from the Free Seats. Greg Kuda, Mike Wisniewski. I'm coming live from the International Home Builders Show, where we're participating in the Startup Zone, which is it's really an honor. Actually, there's some amazing companies around here doing some really cool things. Some of this innovation that this industry is changing. Whether you like it or not, there's change in the wind, and some of it is coming just by force, by need. It's a new environment, a new world that we live in. So, speaking of the new world, lumber futures looks a little wild again this week.
Yeah, we've had a little bit of volatility, to say the least. And Mike, I've got some information. Obviously, we've had these lock limit moves on the way to the downside, lock limit moves on the way to the upside. I've been in contact with CME marketing department and then also CME risk, and we'll go over that. Let's run through everything else, and then we can kind of go over that at the end.
Okay, perfect.
As more people hopefully come on here. So, just to recap, a week ago, we were still in crash mode as far as trying to find a bottom. Orange line is lumber. Since bottoming basically at $900, we've rallied just under 29% now. We've gone from 900 to lock limit again today at 1159.90. In the interim, all the other markets kind of have had these bottoming formations where equities are more in consolidation mode. The one thing that I'll point
Welcome
out
back, Mark.
here is of interest is 10-year notes have spiked now up to 1.93%. They got up to just under 1.96 today. So we're on the precipice of going to 2%. And the old Jesse Livermore, whole numbers don't hold. We'll see how easy it is to blow through 2%. And then you can do the trickle down from there as far as 30-year mortgage rates and the rest of the interest rate curve here.
Well, that I kind of have a personal opinion on interest rates. 2% is more than 0% or 1%, right? But is that going to stop you from building a house? The lumber prices went up 300%, and that didn't slow anybody down. So I think as far as consumption goes, there is probably some room to run on interest rates. But obviously, as you get to 3%, 4%, 5%, that's game changer time, right?
Yeah, and so the other big thing with interest rates, when you have all access to all this free money, you create all this debt. As that debt comes due and has to reset at higher interest rates, do you have the cash flow, the revenue to justify the debt? And that's going to be, that's the trickle down from big brother, the government, all the way down. As money is no longer free, historically it's still free, but it's not as free as it was 6 months ago, a year ago. So that becomes the interesting dynamic here. Do you have the cash flow, the revenue stream to justify the higher reset of debt? And we'll find out how, just from housing to the economy as a whole, as debt resets at higher interest rate levels, how is that absorbed?
Right. At 2%, is it a headwind? I'm going to say no, but it's definitely becoming less of a tailwind for sure.
Sure. And I agree with you there. So here's a weekly continuation chart, and you can see the insanity. We talked about that 50% area to the downside last week, Mike, the 50% retracement area, Fibonacci. We didn't get quite to 50%. We got close. And now we're back up through 62% on this move higher with 1159. The one thing that's obviously the elephant in the room here is the lack of liquidity or the lack of volume. And you see these little dots. That's not overly encouraging. This is front month futures. It almost looks like you're looking at November here. But like when I point these out, you had 85 trades today on this bar right here. You had 49 trades here. You had 79 trades here. Magically, we come off limit. We trade almost 1,000 contracts in the front month. And then to go back to the upside here, you had 149 trades here. You had 57 here. 95 here, 48 so far today. Strip out the spreads and you can almost half these numbers. So that's the big disconcerting thing, is the complete lack of illiquidity right now in futures, in that you beat the out of the longs to the downside. You're doing it to the upside here, and I know it's frustrating to everybody as far as the lack of liquidity. And we'll kind of go into this in greater detail as we go through the slide deck. But so here's your weekly continuation. The insanity here, and we'll get more detailed with the basis futures basis relationship. You went from this bloated premium where futures was $100, $150, $170 plus. You went to a crater mode in futures where futures traded sub 250, 270 to physical cash. And now as you blow this up, we're starting to converge where futures, you've got cash that's basically flatlined here. Futures, and I think this actually, you'll see it in, let me see, here's the March daily. I'm not going to beat up on this too much. That's just see the illiquidity. But here's the March basis, where a week ago, March was trading $265 under physical cash. Fast forward to today, you're within $50 now. So,
Well,
so
I
that's
think
a heck of a move.
you can make the argument that March futures is actually at 1250. It's 2 limits above is where you could, if you wanted to
Sure,
sell a
sure.
contract, you can sell a contract today 2 limits above using the spread market.
Yeah, using the spread market and the synthetics, the limited trading and options, but obviously the implied volatility, I agree, says otherwise. So this is the March basis. Here's the May chart. Again, lack of liquidity. The one thing of note, though, is that with yesterday's trade, I'm going to read this off of open interest here. March volume was 95. May volume was 105. July volume was 116. So guys that couldn't come out of March were spread trading, either rolling the March misery into May or trying to get filled in those back months where you did get some trading in the July contract yesterday. You did get some outright trading in September. So if you would have bought, you could have bought those back months and came out of a spread. Now you're going to pay for that, but it gives you more liquidity than just trying to come out of the March outright.
Correct. Yep.
So here's May basis. Now, the May and July basis charts are just staggering. A week ago, May was trading $315 under cash. Fast forward to today, you're within $109 of cash now. And then same thing in July. July, you went from a $340 discount. Now you're into $142, which is just, you've had a significant run. And I'm going to come back to these spread charts, Mike. I want to just jump. Let me just find this here. So this is the amazing thing. I tried to make this as easy as possible to understand. Since January expiration, cash, we had a $1,200 print. We went up to 1225. We went down to 1180. I'm going to assume that print's going to be somewhere in this 1210 plus area tonight. That's where West Fraser is right now, still 1210. So you've had a collective from the 1200 up to 1225, back down to 1180, up to 1210. You've had a $100 trading range in Western SPF 2x4s. Now, that's an approximation. Somebody's going to say, well, I bought cheaper. But basically, you've traded in a $100 range since the 14th of January. In futures, we've had a high of 1338. We traded down to $900, back up to 1159, basically 1160 today. So the collective range is just south of $700 in March lumber futures, if you look at all the peaks and valleys since the 14th of January. So for every $1 move in cash, you're getting a $7 move in futures, which is just staggering. I mean, that's the ultimate definition of volatility right there.
Indeed. And it is interesting. Cash kind of put a stake in the ground and futures traded around it.
Yeah, the mills held their ground. We're not going to come off. And the deals, the values were in the board here.
And I think this highlights the fact that lumber futures is not the lumber market. Lumber futures is for lumber delivered in that window between March 15th and March 30th.
Yeah, so, futures is futures, cash is cash until you get that convergence, until you get into that time frame where you're in the same order file. Absolutely.
Right. They're pretty related cousins, but they are not the same thing. So, today's market is different than what the market will be in late March.
So we'll go back to the spreads. Here's the March-May spread. A week ago, that spread had bottomed in the, let's call it 55 to 48.60 area. Synthetically, the spread, because of the limit up moves, is still settling in this sub $60 area. But the actuality is the spread is traded out to 120 so far yesterday. It's traded out to 117.60 today. So, you definitely have interest in owning something. And one way of doing that is front spreading the market, where even though you're getting an artificial settlement based upon the outright closes, you've still seen from a spread standpoint, the spread has had a pretty dramatic move back out. And it actually took out the highs of the last move of 115. Interestingly, the March-May is the only one that's taken out its recent high. March-July hasn't done it so far. May-July hasn't done it. May-September hasn't done it. July-Sep hasn't done it. And so here's the May, July. A week ago, this spread had traded into somewhere in the 25 to 22.70 area. Today, this spread is back out in the 66 to 67 area. So you can see you're back into a 50, 62% box here as far as, you know, at the wide, I think at the wide end, it traded just, I want to say somewhere in that $98 area.
Sounds about right. Yep.
Open interest. This is a week ago, 24.11. You can see front month open interest is 15.45. You can jump down into each of the back months thereafter. Fast forward, there's not a big change in the aggregate open interest. You know, you're 24.11, 23.94. The big difference is the liquidation, obviously, of March, and then the build in May, July, September, and November. You know, you're getting a steady build in these back months, while March just beats people up. You know, you're getting flight to quality in these back months one way or the other, where, you know, on the way down, I couldn't come out of my March long, so I better sell, you know, a back month. And then same thing holds true to the upside. I can't come out of my March shorts, so I'm having to buy back months. You know, people are using the back months to try to attempt to kind of neutralize the March misery right now. You know, above and beyond, you know, in industry type guys, forward buying, you know, selling, that kind of stuff.
We had a question here from Travis Lund. Which indicators are you using on the bottom? I'm going to assume that he meant when we were bottoming out. And what's important is to use the same indicators all the time. If you start choosing different indicators, you're going to have inconsistency in your data.
Yeah, yeah.
So, you know, Greg, I think what we've been, or I'm sorry, Travis, what we've been using here, we're looking at volume and open interest. We're looking at the commitment of traders reports, and we watch the activity in the spreads. These are, you know, real concrete pieces of data that will give indications of, you know, trends in that market.
Yeah, and again, I think to say that what works for me might not necessarily work for Mike or vice versa. You have to pick stuff you're comfortable with, that you have a high degree of reliability with. And I would say that there's no holy grail when it comes to some kind of metric or technical indicator where it's a combination of, you know, I tell people look at 5 different things, and when 3 out of those 5 kind of line up, then that's a pretty good indicator. You want stuff to mesh up either to the upside or the downside as far as your fundamental, your technical, your statistical analysis. You want stuff to overlay, and you know, when everything starts to kind of point in the same direction, then you know you're getting close.
This is very true.
So CFTC numbers. This is the most recent as of February 1st, and the big thing here, Mike, is
we wanted to look at this last Tuesday.
Yeah,
we talked about it.
yeah.
This is a,
And you know, you said you were going to see a big net change in this managed money, and you were spot on. So this was up over 700, 462 down 258. So commodity fund longs hit the exit button, got trapped, and then, you know, kind of that not seeing the net change in total open interest. Well, these guys were coming out. Commercial longs, this is your forward buying, stepped in, and then you also had some light profit taking with the shorts. You know, these are the small shorts, small longs. So the net effect is down 122, which again is the managed money coming out. But to absorb that net 258, you know, you had an increase in commercial longs. And you know, a decrease of the small round reportable guys. And again, this will be interesting to see later this week. Again, without that big change in net open interest, you know, where we're at here. So this kind of leads into the volatility and some of the underlying ongoing issues as far as liquidity when it comes to trading lumber. And, you know, all I'll say is that, again, we talked about this last week. Lumber is at an historical high from an implied volatility standpoint. And when you compare it versus other commodities, this is from more research. Lumber is basically at the top of the food chain, and this is actually a couple of days old. So I think March would have is actually number one now. But you can see relative to all these other commodities, lumber, each lumber month is basically, I would say if not top five, definitely top eight right now. So you have extreme volatility in the marketplace right now. And you're just getting massive spikes in the implied volatility on a day-to-day type basis where, I think it was, I had contacted the Globex desk, they had settled options, and a lot of the options were synthetic settlements. This was on last week, I think last Thursday, where you had net change in March futures was up 45 limit bid. You had out of the money calls in March. At that point, I think you were 24 days to expiration, where you had out of the money calls, and I'm talking like $150 out of the money, settling greater than the net change in March, which was just defied all logic, where the implied volatility was that explosive, where you had a 1250 call, for instance, that was up $59 on the day, that far out of the money, with March settling, I think at that point, March was still in the tens, up 45 on the day. So, this is your ultimate example of implied volatility makes options more expensive, and you'll get some wild moves in the options as a result.
Sure, there were people using the options to exit their position. They were buying calls and selling puts at the same strike, which becomes a synthetic long position. And
Sure.
they were willing to do it at over $90. In fact, I think I saw some trade probably almost $100 over where March settled.
Yeah. Yep. And so this becomes interesting with 22 days to expiration in March. If you keep on this trajectory, then it all makes sense. The second this market stalls out with under 30 days time decay, if you get one move to the downside, these options are going to give up, especially out of the money options will give up their value almost immediately the second this market stalls out.
Absolutely.
So let me see. We'll go over this and then we'll jump back. I want to jump back to that CME stuff we talked about. Rail car stats, you've this is the CN miles per day. It's still showing a marked improvement, although when you talk to the sawmills, they're not getting rail cars. There's still significant issues coming out of Canada. This is the tough part. I mean, you see, this is this year so far. So we're making, according to Association of American Railroads, we're making headway here. The difficulty is, again, this shows that it's forest products, but when you talk to the sawmills and you talk to people out there certainly seems to be major hiccups when it comes to rail car allocation and rail car delivery coming out of Canada.
That's an important stat too.
One.
That's how fast the flow happens.
So, yeah. And I think, to me, the $1 million question, is this a demand driven rally or is this a supply constraint rally? And the inability for sawmills to transfer their finished goods to the end users, leads me to believe that this is more supply constraint driven than underlying demand. I think underlying demand is more of a known this year versus last year. It's the supply side of the equation that still seems to be the catalyst to move higher right now.
For sure, demand is fantastic. It's not going anywhere in the near future. So all the volatility comes from, if there's a perceived constraint in supply, and demand tries to buy more wood in a shorter period of time, you will see escalation in prices.
And then, Mike, I just want to, that option example of buying a 950 put, selling a 1250 call, I just want to reference this just week over week to show you how much these options have moved. So the 950 put at one point would have been in the money. At its high water mark, it actually traded out to about $100. You know, last week it was in the 84.40 area. This
I am
12.50 call was in the 12.10 area.
doing a LinkedIn live show. If you come back in a little bit, I can talk to you. Sorry about that, Greg.
Yeah, no worries, no worries. And then you look at it today. Again, I'll jump back. A week ago, this 950 put was at 84.40. 1250 call was at 1210. Theoretically, this 950 put is in the $5 area today. The 1250 call is back up in that 67.50. So this went from basically at the high end $100 back into $5. It lost $95 in value. The 1250 call, I think at its low water mark was somewhere in that $10 to $12 area. Synthetic or theoretically, it's back in the 67.50. I think it's 60 bid at 100 ask right now. So, you know, you're getting just massive moves because of the implied volatility.
Absolutely. You know, the options are tied directly to that movement in lumber. And in fact, they exacerbate it a little bit more because they do allow you mechanisms to exit when you're at a limit.
So this leads back to, obviously there's liquidity issues with lumber right now, and you know, lumber is functioning. Lumber futures are almost functioning like our cash market, where you know, if you wanted to buy, you have to join a pool right now of 300 plus in March. You know, like the idea, if you wanted to buy 300 cars of Western SPF 2x4s, I don't think you could do it if you wanted to. I don't know if you could buy 50 cars. You'd probably have to call every sawmill you know to pull that off today. So illiquidity has transferred from cash into futures, unfortunately. And I've been in contact. I know a lot of the other brokers have been in contact with the Chicago Mercantile Exchange. And you have to understand the CME, and Mike, you know this better than most, is basically divided into silos. You've got the risk management, market surveillance silo. You've got the marketing, new, you know, existing contracts, new contract silo. And a lot of the times these silos don't talk to each other. They're completely autonomous from each other. So when you talk to CME marketing, you know, that's the one that is trying to have inclusion of SPF S, of Eastern SPF. That has nothing to do with the risk element of the CME. So CME is actively looking at the illiquidity issues with lumber futures right now. And one of the things that they're looking at is, and this could happen with the special executive notice. So they are under a lot of pressure from the CFTC. The CFTC monitors this. It rolls back to the CME. So the CME right now is looking at the idea of removing limits for lumber in all months. This is something that I'm hoping they give a 24 to 48 hour notice, but this is something they could implement ASAP. It's under their guise to do that from a regulatory standpoint. I think this would lead to the idea of a circuit breaker approach, where when you look at something like the S&P or the stock indices, they have circuit breakers at 5 to 7.5 to 12%. So if a market trades beyond 5%, 7%, it triggers a circuit breaker. The market stops trading for 10 minutes, and then it resets where the banding increases from 7% to 10% to 12%. I think that's something that will likely be implemented with lumber down the road, more so than just these arbitrary, you know, we're going to have a limit of $45 or $30 and expand. That obviously isn't working with lumber. You know, historically speaking, the CME likes to see markets trade at limit moves about 2 to 3% of the time. When you look at lumber, we're lucky to trade without limits 2 to 3% of the time as of late. So this is, internally, this is unacceptable. And from a regulatory standpoint, this is not the model of price discovery. It's not an efficient market. So this is being reviewed as we speak. And this is something that can happen from a regulatory standpoint immediately. So this is something to watch.
Greg, what's your gut feel? What do you think is going to happen and when?
I think they take the limits off, and it could be either, it could be as soon as this week, in the next couple of days to next week. You can't have a market lock limit with 300, 400 in the pool, you know, and part of this is it's pretty apparent. And again, this is my opinion. I'm stating my opinion now, but I know people that have TT machines. These are all trading platforms. I know people that use CQG Trader, TT, that use clearinghouse platforms. And when you put orders in the morning, I don't care how fast you are, there's an algorithm that's already got X amount in the pool day after day after day. So you're creating these massive pools, which defeats the purpose of price discovery. And short of not allowing certain people to trade, which you're not going to do that, the answer is you're going to remove the limits to allow this thing to float to where it ultimately belongs.
Right. It's kind of front running basically, and
Yeah,
just
yeah.
locking people out of the market.
Yeah, and again, to not see the change in open interest, where it's obvious that somebody's building a position, not building a position, you don't see it materialize in day-to-day changes in open interest. So it's apparent that whatever this is, you could have the argument, it's good, bad, but right now you have illiquidity, and that's got to change. So this is on the forefront. I know there was a survey that went out from the CME. So again, this here is CME risk. Okay, this is a completely different silo. This is CME marketing. This is new contract. This is a completely different part of the CME. And they sent out the survey on the inclusion of SPFS, HEMFR, DUGFR, Eastern SPF. There is a major divide on the inclusion of these other ones here because of grading, US grading versus Canadian grading. So the idea is that they might segment out Eastern SPF and fast track this, and then try to incorporate this at some point. All I would say is the CME doesn't want to hear from Greg Kuda, the broker. They don't like to hear from us. They like to hear from customers that actually use the product, not people that follow futures and don't use it and have opinions. No, they want to hear from the actual people that use the contract. So, if you have interest, if you contact me, I will provide you with the right people, but they want to hear from people that actually use this contract from a risk management standpoint. This ultimately was created as a risk management tool. That's who they want to hear from. So if you have an opinion on this, then by all means, you're more than welcome to give it. But ideally, it's from people that actually use this contract. With the idea, we're trying to nitpick on what can be delivered. 1% of these contracts are actually delivered. Everything else is EFP'd. So this is the problem. We're getting hung up on stuff that theoretically is unlikely to happen. So this is the frustrating part of the CME.
Well, I can tell you these things go in waves. I think we're going to see a stable lumber market coming around in sometime in the future. It's not going to be tomorrow, but it will fix itself. There is no doubt. All right, hey, we're up on about 30 minutes. Greg, thank you so much for the feedback from the CME group. That's very helpful. Once again, all of your data. My personal opinion is we're closer to an end of this run up than we are at the beginning, but
yeah,
that's just what I'm thinking. Right now, it looks like that 1300 is the target on the upside. Today you can actually right now in the market, if you wanted to sell a March, you can sell one for around $1,240, a little over a limit and a half, just under 2 limits up, by selling July and getting out in the spread market, or moving it over to March in the spread market. So these are things that you can, if you work with a good broker like Greg Kuda, they can help you get into these markets and out of these markets as efficiently as possible. So with that, I'm going to wrap it up here from the International Building Show. And we will talk to you next week. Greg, I'm going to be really curious to see what happens in the Commitment of Traders report again.
Yeah, definitely, Mike. I appreciate you taking time out. I know you're busy today. Enjoy the rest of the show. Enjoy Orlando, and we'll talk next week.
All right. Sounds good. Take care.
Thank you, everybody. Take care.